Hi everybody, welcome back to another video. In this video, we will cover 3 Capitaland REITs results which I feel that they have performed quite decently in this high interest rate environment. The 3 REITs will be Capitaland Integrated Commercial Trust, Capitaland India Trust and Capitaland Ascendas Reit. Of course, these are just my analysis and opinions. Please do your due diligence or research before putting your hard-earned money into investing them. Let us go on to the first REIT, and that is Capitaland Integrated Commercial Trust. CICT is a REIT that focuses on retails, offices and hotels. What makes them unique is that they have most of their assets in Singapore. Singapore properties are currently the properties that are consistently performing well, and those REITs that own majority of Singapore properties tend to do well. They have recently made a huge purchase of 50% stake in Ion Orchard Mall in Singapore. This makes their Singapore property percentage even higher. Ion Orchard is one of the most attractive mall and in a prime area location, which makes the asset so good. When REITs does equity fundraising, it will dilute shareholders with more shares. Therefore, it's very important that any purchases by the REITs must be DPU accretive so that it will benefit shareholders. In terms of performance, CICT is performing very well with revenue up 1.7%, while net property income is up nicely by 5.4% year over year. All the different assets classes are performing well. This is because it has most of the properties in Singapore. With Singapore having limited properties, Singapore assets are always in demand. With demand, this meant that REITs are able to lease to tenants at a higher price. So in the next quarter's results, if the finance cost does not increase that much, CICT's dividend for this upcoming quarter might come in higher. If we look at the results, CICT has been doing well in the retail side with rental reversion increasing 9.2% year over year. This shows the attractiveness of CICT's retail properties in Singapore. Next, office properties are doing decent. CICT's average rent for offices in Singapore continues to go up to $10.72, which will potentially bring in more income. Only part of the occupancy drop is in their Germany office, which dropped due to the enhancement work in one of their office properties. With the leases performing well, having leases expiring will definitely benefit CICT. For the next few years, there will be a lot of leases that needs to be renewed, and this will potentially increase CICT's income as long as the rental reversions come in positive. Debt maturity-wise, their debts are spread out evenly for the next few years, which might be a good thing. With the needing to be refinanced, it's very common for REITs to have increase in average cost of debt due to the current high interest rate environment. As we can see, after the purchase and the issue rights, CICT leverage ratio is stable at 39%, but the average cost of debt went up slightly to 3.6%. So in the next quarter result, we will be able to see Ion Orchard contribution to CICT's overall income. This will definitely boost CICT's income, but we'll have a smaller increment in the dividend due to the increase in the number of shares of the company. Next, another thing to observe similar to most of the REITs is whether the increase in the income will be able to offset the increase in their finance costs. If that is possible, then CICT will be able to announce a higher dividend. At the current share price, with semi-annual dividends given, is at a dividend yield of 5.6%. Longbridge is a broker that has been in Singapore since 2019 and is licensed by MAS. Longbridge is a very clean and user-friendly platform that allows you to trade across Singapore, Hong Kong and US market with attractive fees of as low as $2 per order. They also offer useful tools such as real-time data, company research tools, latest news and charting tools. They also have a good AI tool where you can ask on companies' recent results and analysis. In the season of Christmas, they have just upsized their offer. New users get lifetime free commission for US and Hong Kong shares, and by depositing $2,000, you will get $50 option cash coupon and additional $18 cash exclusively when you use my link to sign up. Moreover, by making 3 trades and keeping a net deposit of $2,000 for 30 days, you will get 1 NVIDIA share worth $180. Depositing $10,000, making 5 trades will get you 1 Apple share worth $310. Transferring shares in can also earn you stock cash voucher, AirPods or iPhone 16 Pro Max as well. Full terms and conditions, including the eligibility criteria, can be found on the Longbridge official website. If you're interested, you can use my referral link in the description box below, and this will also support my channel as I'll receive reward when you sign up. Thank you, and let's get right back into the video. Let's go on to the next REIT, and that is Capitaland India Trust. CIT is a REIT that focuses fully on India market. They have properties mostly in IT parks, and what makes CIT so attractive is that they have a lot of growth pipeline plans. One of the attractive pipeline to me will always be the Capitaland data centers. With data centers being crucial for AI development, this asset class will be the potential cash cow for CIT. Looking at this quarter's results, they are still giving consistent good results with net property income increasing 14% year over year. This was thanks to good performances from both existing and additional properties. For the 9-month comparison, it's even better with 18% increase year over year. This increase shows the quality of CIT's properties and the ability of the management in improving the REITs itself. So far, CIT has been managing their finances well. By hedging some of the debts in India rupee, it can help to decrease CIT's debt if rupee weakens. Most of the REITs gives out 100% of their income as dividend. CIT only gives out 90% of their income while keeping 10% for growth. This reduces the amount of issuing shares needed to do fundraising when making any future acquisitions. Moreover, it's quite impressive that at 90% payout ratio, their share price are priced such that the dividend yield is at 6.5%. Looking at their debts, they will have quite a lot of loans that needs to be refinanced in the next few years. However, the good thing is that their current cost of debt is at 6%. The refinancing might not have much impact to their finance costs since the interest that they are paying is already near the benchmark rate for India. However, we will not know until the next quarter's results. If the refinancing of this portion of the loan causes their finance costs to increase significantly, we might see a disappointing drop in their dividend. For lease expiry wise, there is not much leases needed to be renewed for the next 2 years. For CIT's growth pipeline, they have been very actively improving their properties, and on top of that, they also have data centers that will be constructed down the road. So what can we conclude for this quarter's results? For CIT, giving out 90% dividend payout ratio is enabling CIT to grow throughout the years. The attractive properties and data centers will be able to give CIT positive rental reversion and increasing their income. Next, since the cost of debt is already at such a high level, refinancing will most probably not affect their finance costs as much. For risk-wise, overseas REITs will always have currency risk and uncertainty risk. A next risk that it might have in the future is that it will not be able to achieve high occupancy rate for their data centers due to the insufficient energy available. Therefore, for CIT, the worst might be over in terms of the finance cost as it might not go up any higher. I will honestly be surprised if the cost of debt continues to go up when they refinance their loans. At the current share price, with semi-annual dividends given, their dividend yield is about 6.5%. Next, the third and the last REIT will be Ascendas Reit. Ascendas Reit is one of the largest REIT in Singapore that has very diversified portfolio. They have properties mostly in Singapore at 65%, while having overseas properties in US, Australia, and Europe. With so many different properties, it gives Ascendas Reit the advantage when they make improvements to certain properties. The temporary downtime due to the improvement will not greatly affect the overall income of the REIT. Ascendas Reit has been busy making small changes to their portfolio. As you can see, currently they are doing asset enhancement to one data center and one business space. Hopefully the asset enhancement will bring in more income for Ascendas Reit. They have also divested one logistic asset with a huge premium. Looking at the specifics, this is a good sales as they are selling at 67% higher than the recent valuation of the property. This shows the demand that Singapore properties can bring, and it's important that by selling these assets, the REIT is able to use that money for better investment or bring down their debts. Next, if we see their debts, leverage ratio continues to increase but stay below the safe level of 40%. Adjusted interest coverage ratio is at 3.5 times, which includes the perpetual security holders. For those who are not familiar, REITs can loan cash through two ways. The first is taking on loans, or the second is through issuing perpetual securities. We can see from their first half financial report, the perpetuity securities are not at a very big amount of 298 million, which is okay. But there are some REITs which take on a lot of perpetual securities, and as investors, you have to be very careful about it. One of the easiest way to see if the REIT has a lot of perpetual securities is by looking at the differences between the interest coverage ratio and the adjusted interest coverage ratio. Ascendas REIT's debts are evenly spread out. However, there might be a slight increase in their finance costs when they have to refinance 11% of the debt when reporting the next quarter's full year 2024 result. With that in mind, their finance expenses will increase. Their income will definitely have to increase in order to ensure their dividends maintain or increase for the next quarter's reporting. If we see their portfolio occupancy, it's not doing well with Australia experiencing drops. Reason was due to the expiry of a tenant which caused the logistic property to drop temporarily from 100% to 6.1%. Good thing is that it's a logistic property which may not have an issue finding tenant. On the positive note, rental reversions continue to be strong for Ascendas REIT at 14.4%. With the rental reversions coming in strong, hopefully the income increase for the new leases will be able to offset the increase in the finance costs. Based on the first half results, they experienced lower DPU of 2.5% year over year, even though their distributable income increased by 1%. This was due to the large increase in the number of units of 3.7%, and that is a common problem for all REITs. When REITs announce private placement or rights issue to get money from shareholders, it will dilute overall shares. That's why it's important to know what they are doing with the fund raise. Usually they have a document stating the use of the proceeds for the issuance of the units. For this case, with 500 million raised, 139 million and 129.9 million was used for funding additional assets. 64 million were used for redevelopment of assets, while 160 million was used for debt repayment. Lastly, 5.8 million was used for fees payments. So for this upcoming quarter's dividend, hopefully Ascendas REIT will be able to announce positive increase in dividend. Overall, what are the summary for Ascendas REIT? First, Ascendas REIT's positive rental reversions will be able to allow them to bring in more income. Second, their asset enhancement will be able to bring in more income for Ascendas REIT as well. There will be a potential increase in the finance costs due to refinancing of the debts expiring in financial year 2024. If the increase comes in not as much as expected, Ascendas REIT's dividend might be able to come in higher. At the current share price, Ascendas REIT's dividend yield is around 5.9%. In conclusion, the three REITs are doing decent. The common thing we can see from the three REITs is that their income can increase due to the positive rental reversions. However, the important factor will be their finance costs when they refinance their debts. Thank you so much for watching. If you like the analysis, please support the channel by hitting the like, subscribe, and comment on what are your thoughts on the three Capitaland REITs results. You can also watch my recent analysis on Mapletree REITs or the bank's amazing results. Thank you, and I'll see you in the next video.